Unveiling the world of financial derivatives, the foundation. Financial derivatives are special contracts. Their value depends on an underlying asset like stocks, bonds, or oil. Derivatives allow exposure without direct ownership. One key use is managing risk, often called hedging. Imagine a farmer using derivatives to lock in a crop price, protecting against price drops. Speculators bet on future price movements. Derivatives also help in price discovery, showing market expectations. Many types of assets can underlie derivatives, including stocks, bonds, commodities, and cryptocurrencies. Futures contracts are a major type of derivative. A futures contract is a binding agreement to buy or sell an asset at a future date for a predetermined price. This removes future price uncertainty for the transactors. Futures are standardized and often exchange-traded. Understanding derivatives opens doors to complex markets. They are essential tools in the financial world. Stepping into crypto derivatives for digital assets. Crypto derivatives follow the same core principles as traditional derivatives, but use cryptocurrencies like Bitcoin or Ethereum as the underlying asset. Cryptocurrencies are known for volatility, and derivatives can help manage this. Miners or long-term holders can hedge to protect their crypto's value. Speculators use them to bet on price movements without holding actual coins. Several types of crypto derivatives exist, including futures, options, and perpetual contracts. Perpetual contracts are like futures but without an expiry date, making them attractive for continuous speculation. The crypto derivatives market is expanding fast, showing the maturation of crypto finance. Initially a niche area, major exchanges now offer these products, attracting institutional investors. The volume of crypto derivatives trading often surpasses spot market trading volume. This indicates their growing importance. Crypto derivatives bring traditional finance tools to the digital asset space. They offer flexibility and new strategies. Understanding them is crucial for engaging with the evolving crypto market. Crypto futures explained. Mechanisms and specifics. Crypto futures are contracts to buy or sell cryptocurrency at a future date for a fixed price. Traded on exchanges, these contracts are standardized. Trading often involves leverage, amplifying both profits and losses. Exchanges reduce counterparty risk. Traders take long positions if they expect prices to rise or short positions if they expect prices to fall. Settlement can be physical or cash. Understanding these is vital for traders. Futures offer a structured approach to the volatile crypto market. Exchanges ensure orderly markets and manage clearing. This makes futures trading more accessible and secure. Section 4 illustrating crypto futures real-world scenarios. Bitcoin miners use futures to hedge against price fluctuations. They can sell futures contracts to lock in a sale price. If Bitcoin's price falls, futures gains offset spot losses. Speculators buy futures if they expect prices to rise. Leverage allows them to invest with less capital. Profits come if prices exceed the futures contract price. Arbitrageurs exploit price discrepancies between futures and spot markets. They buy on the spot market and sell futures for risk-free profit. This helps align futures and spot prices. Exchanges like CME, Binance, and Kraken offer these products. They ensure orderly markets and manage the clearing process. Without these exchanges, futures trading would be difficult. They are central to the crypto derivatives ecosystem. Section 5. Weighing the odds. Benefits and risks in crypto derivatives. Trading crypto derivatives offers several benefits, including hedging against adverse price moves and aiding in price discovery. Futures prices reflect market sentiment about future value and can increase liquidity in the overall crypto market. Leverage allows traders to control large positions with relatively small capital. Derivatives provide access to crypto markets without holding the coins, avoiding wallet security issues. Transaction costs can sometimes be lower, especially for large trades. Sophisticated trading strategies become possible, appealing to advanced traders. However, significant risks are involved, including high volatility and leverage, which can magnify losses. Liquidation risk occurs if margin falls below a certain level, leading to forced position closure. Counterparty risk exists, though regulated exchanges mitigate this. The complexity of derivatives can be a risk for beginners, leading to costly mistakes. Regulatory uncertainty varies by jurisdiction and can impact traders. Understanding these risks is crucial for anyone engaging in crypto derivatives trading. Proper risk management techniques are essential. Section 6. Key takeaways, navigating derivatives and futures wisely. Let's summarize the key points. Derivatives are financial contracts whose value comes from an underlying asset. Crypto derivatives use cryptocurrencies like Bitcoin and serve purposes like hedging and speculation. Futures contracts are agreements to trade at a set price and future date, now applied to digital assets. Understanding the mechanics is crucial, as crypto futures involve long and short positions and leverage. Settlement can be in cash or physical crypto. These instruments require more knowledge than basic spot trading. The crypto market is already volatile, and derivatives add another layer of complexity. Thorough education is essential. Never trade what you do not understand. Crypto derivatives are increasingly significant, becoming a core part of the crypto ecosystem. They offer tools for sophisticated risk management and new avenues for speculation. Institutional adoption often involves these instruments, reflecting broader acceptance of crypto. The path forward requires careful navigation, starting with education. Crypto derivatives are powerful tools that demand respect and skill to use safely and effectively.